We're just hoping right now, Pankaj, that it doesn't get followed by a 2020 COVID-like situation. We're okay dealing with the 2013 to 17, 18 kind of patch. But tell me, where is it that you feel further downgrades are in the pipeline and we're not quite bottomed out in terms of the earnings pain in the second quarter?
So we believe that on the industrial side, the valuations are still on the higher side. Order inflow growth has been a little slower, and margins are at cyclically higher levels. The disappointment on margins could be a possibility as you move ahead into the next few quarters. So that's one space you should watch out for. Already the stocks have corrected by 30-35%, but earnings downgrade may follow probably once you start see some margin contraction starting to happen in few companies in that sector. So that's one space. The other space is on the FMCG side. Though we are positive on consumer discretionary, but on the FMCG side, I think the estimates on the street is still on the higher side, so one needs to be a little careful on that. On IT, again, I think the stocks have done extremely well. Index is the best performing index in this correction as well. And the estimates for FY26 is still very high. Anything from Trump on visa issues or anything to do with immigration issues may not be taken well by this sector. So I think volatility could be there as you move ahead into IT sector as well.
It's interesting because we've been speaking with a lot of market experts, and it seems like the flavor is returning back to these pharma plays and the entire healthcare sector as well. But then there's always that conundrum when it comes to the expensive valuations that some of them command. What's your outlook on how investors should play the healthcare space?
So we believe that healthcare is one space which has shown consistency in earnings over the last 8 quarters, whether it be US generic pharma companies, Indian domestic facing pharma companies, or hospitals. I think the consistency is clearly there in earnings. And even in this quarter, many companies have reported in line earnings as per the street expectation. Going forward also, I think one mega trend which is in making is the CDMO place. I think the US Biosecure Act, if you go into deep, I think it's a great opportunity for Indian CDMO players. And when we speak to many of them, the sense we are getting is that already inquiries have started. And if Trump is very serious about China plus one, I think CDMO could be a bigger trend in making as you move ahead, because apart from China, the only country which possesses chemistry skills in such large abundance is India. So you cannot ignore that. Also, the Indian market seems to be doing reasonably well. We believe that this Indian pharma companies have characteristics of all FMCG companies in terms of gross margins, return ratios. And if the volume growth continues between 8 to 10%, some players doing better than that, I think it's a great proxy for FMCG in your portfolio. Rather than owning FMCG, you can own domestic facing pharma companies. And third is the US generics, where we have seen for the last 18 months changes happening where price erosion has got arrested. And incrementally, companies have started making money as the markets have consolidated. So I think healthcare overall seems to be in a good spot. We have a decent weightage in our fund also on the pharma side and healthcare side. And that from an earnings visibility perspective in this market looks to be a good spot, and valuations are not overly expensive out there.
If you like this video, then like, share and subscribe to ET Now.